the framework that you laid out is pretty solid in terms of thinking about the states. When you talked about the obviously good states, the obviously bad, but then there are the ones that are not quite there. Talk to me about who's in those tranches and how you came to that determination.
Yeah, so I think for the US, it is a lot more interesting to put those spread trades on because it's a very diverse pool. So you have lots of states in the US which are offering general obligations or other securities, and you also have, let's say, not a super liquid, but you have some kind of CDS market on a lot of those states.
Right.
And I think the basic logic, and again, that's not investment advice, it's just the way that we would think about that issue, is that you disregard your Kentuckys, your Illinois, your New Jersey, so the worst tier,
right,
where everyone knows that they have issues. There's no secret here. But what about the tier right below that? Like what about the Mississippi or the Nevada or some other places where you say, look, nobody has talked about them. But
so what are the states that no one's talked about that I would be surprised to know is the second tier below, New Jersey and Illinois?
Yeah, I mean, it's exactly those. It's the Mississippi, definitely. We have Connecticut would probably be the first tier. New York would probably also be the first tier. It is, let's say, a lot of states which do not have natural resources. So those would be generally the top tiers. And extremely populous countries with a high population are, let's say, oftentimes a little bit more challenged. Texas being an exception here, given the oil wealth. But it's like middle to smaller states around the fringes, which are like oftentimes overlooked in many ways. So it's oftentimes the flyover states, which are not at the coast. So those are oftentimes, let's say, a little bit more challenged.
And you mentioned Nevada, so they would be a second tier potentially?
On the bad side.
Right.
Yes. Yeah.
Interesting.
Yeah.
And where are the obvious choices on the other side of that in terms of well-funded, and how does that play into when you think about a relative value or a CDS play for that?
Yeah. I mean, the obvious ones, I mean, for me would be like a District of Columbia or Utah is extremely stable and good country. Wisconsin, which is also pretty good. So you have some which are super strong, and then you have, as I mentioned, some which are really bad and in the news, and then the medium to bad, those are ones where I think it would make sense in general to buy some CDS protection. So it would, like a logical trade for me, would be that you're long certain high quality states. Let's say, I mean, Idaho is a good one. Utah, great. Tennessee is also pretty decent. So you can buy, let's say, some assets in those states, let's say GOs, general obligations, and then you simultaneously purchase some credit default swaps on the medium to lower tier. And those would be the Mississippi, let's say, and Nevada.
Right.
And you roughly pay the same. So the spread that you gain is roughly the spread that you pay because it is not obvious.
Right.
Right? Because the market is treating them all the same. It is only treating the bad ones differently. But everyone else is being treated the same. So a CDS on Nevada is maybe 36 basis points, and a CDS on Utah is maybe 33. So 3 basis point difference, that's not a big deal. So you can buy those general obligations, you buy the CDS, and you're left basically with a package which is a US Treasury. So it is the underlying duration component, because the spread that you gain or the credit that you gain, you pay it away. So net, you're at a US Treasury yield, but the return profile in a crisis will be dramatically different. Because if we go into that crisis, you would see those spreads massively changing, where you see the second tier of worse adjusting up to the worst, and the best ones just staying roughly where they are.
And what about leverage and duration in terms of plays of that nature?
I mean, that depends on what abilities everyone has to access leverage. It would make, or it would appear to be a natural play to use some kind of leverage because it's very small differences in spread. So it would make natural sense, but everyone has to see how that fits in their own profile. And I mean, for the funds that I manage, we wouldn't be able to access leverage, or at least for the majority of our funds. For some, we could, but that's something that everyone needs to look at themselves.
And duration, like what sort of time frame are you looking at?
Yeah, so I think there's, again, this is not a trade that you had to put on yesterday, which is great. So I always like, or I dislike when somebody says, I've been right for years and now we're getting to the last little bit and I still believe in it, but I've already made so much money in the past. And so this is, you're at the very, very, very early stage of putting on a trade. So you have not missed anything. You have not lost anything, but you have not missed anything. You work with feedback loops and you work with non-linearity where you say, this is actually not moving until it completely moves.
Right.
So this is something where, and I also like those investment ideas in general where you have very little movement and then you have a massive event which restates and makes for outsized gains in that case.
And that's why the funding structure that you're talking about makes a lot of sense because it's fairly stable over a longer period of time, but very small, but then it adjusts.
Yeah. And I think in terms of timing, I mean, what I would look at is it's actually just equity performance. Because the sequencing, what I mentioned earlier, the sequencing of returns is becoming center stage because a lot of pension funds have matured, so they don't have the capacity to have a bad year, maybe, but 2 bad years would be really, really difficult. And once you get a couple of bad years, and a bad year is not -10 or -20, a bad year is, but your baseline is 7.6%. So a bad year is already 0. So let alone minus something. So a couple of bad years will make everyone look at those pension funds again. And they will say, oh, look, what does it mean if you underperformed, if your performance was so bad for a couple of years, what does that mean? And then I think there's also this reinforcing feedback loop where you had possibly a bad year or 2 bad years, but then what do? Well, as a pension fund manager, you have your pool of money and you see your target slipping away. You have 2 choices. Either you go for the Hail Mary, or you say, look, I'm going to protect what I have so that I at least have something reasonably to pay back. And I would say that most will take the latter option of saying, look, we had too much risk on the book. The market called us. We are swimming naked and we have to make those adjustments and then sell even more in an already declining market.
Very interesting. Any last thoughts on like how to think about this entire retirement crisis? Because as you were speaking, I was thinking to myself, you know, in a down market, a sustained bear market of 20% or more, when you say that 0% is already, when you have a 7% assumption, are going to be difficult. That's a difficult thing for these companies or these countries to and states to deal with.
Yeah, I mean, my few thoughts would be, policymakers do know that this is broadly going on. So there is, I think, an increasing and large incentive of policymakers to not make it happen. So to see that there is an implicit put in the equity market, because that would be a much lesser evil to deal with.
A Fed put, basically.
A Fed put, or even a government put, right? It could be could come from either the monetary side or from the fiscal side. But I think there is a put because the consequences will be pretty dire. So I think there is an underlying put, and we need to take that into account. While I'll see all the doomsday scenario, I also have to recognize that there are players who are extremely powerful and who can move the needle and can move the market. So I think that's an extremely critical aspect. I think another one is that we need to see what would a scenario be of somebody bailing out those institutions? So let's say if that put were not to work with conventional policies, like what is the next step? So what will happen if one major pension plan, another one, a third one, all go bust? What will happen? Who will step in? But here I think that it has to get, like, for the easy puts that are in place from the fiscal and from the monetary side, if that doesn't work and we actually see some defaults, some more defaults, then what will the consequence be? And I think that here the path will be that the federal government will have to step in, because it's too critical, too crucial of a component of society that they can just let it go and say, okay, you, California, you deal with your own mess, and New York, you deal with yours, and Wisconsin, you deal with yours. So I think there will be a federal bailout eventually going to happen, but it is something that probably needs to get a lot worse before it can get better.